Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. Well, it's 1 o'clock on the East Coast on this Thursday, September 19th. The month's going by like, watch this.
Bang. Like that.
Of course, September is the letter U for you playing our home game in the futures world. Guy, Adami, Dan, Nathan, soon to be joined by the great Carter Worth, that of Worth Trading. There's a lot here. There's a lot here to talk about. Yesterday, the market had that bit of a reversal late. The bond market sold off. We made a new all-time high in the S&P, Dan, and it felt as if maybe that was the beginning of something. Of course, only to be offset by the futures action last night and what we're seeing today. So let's throw the rundown up, because why not? Fed cuts, stocks soar. Fed cuts, stocks soar. If I put another word in at the beginning of a haiku, maybe I'll work on that later. Chart check on the SPX and the NDX, and software in the saddle. Of course, that's homage to the great Aerosmith song, Back in the Saddle Again, Dan, Nathan.
No doubt. That would be Carter Worth. You said of Worth Trading. That's Worth
Oh, did I say trading?
I apologize.
What am I thinking?
Well, you know what? Carter has this when he signs off many of his posts from Worth Charting with trade well, rather than like sincere wishes or best wishes. He says trade well. We're going to get to him in a couple minutes, because he's going to hopefully make some sense of some of the stuff.
Hopefully somebody will.
You know, Guy, it's really interesting. Remember on June 10th, WWDC, this is one of the biggest events for Apple all year long. They're basically going to roll out all the new software, whiz-banging features or whatever that are going to go on the new phone. And, it's interesting. We were sitting there and they launched this Apple Intelligence. It was going to be their take on AI on device. They had not mentioned anything about AI for about a year. The stock was in the penalty box for the most part because, Google and NVIDIA and Microsoft and a handful of other names were taking all the headlines. And the stock closed down after kind of a volatile session after the stuff was presented or whatever. Closed down like 1.5%, 2% or something like that. And we were like, okay, that makes some sense. Nobody was particularly impressed by that. And then what happened, if Amanda can just kind of isolate those 2 days, it was June 11th and June 12th. A $3 trillion market cap company went up 10%. Look at that. In 2 days in a straight line. It kind of held those gains, consolidated, and then took off again. So when I think about what happened yesterday, the much anticipated rate cut, you and I were talking about it with Liz Young about 24 hours ago, that we can't remember the first move by the Fed having like a toss up, whether it was going to be, you know what I mean? Like whether it was going to be 50 or 25. The stock market closed down yesterday. And then what happened? Like out of the gates, off to the, you got it. So it's similar sort of price action. My question to you is that, are those people making those decisions? You know what I mean? Or are those algos making those decisions? Because when you open up the way we did, and then that's basically the low tick of the day, assuming that we close very near the highs, that is a very, very powerful sort of move.
Yeah, I think most of the time, listen, and I know you know this, but I think most of the moves that we see on a day-to-day basis are generated by whatever you want to call it, whether it's algorithms, computer learning, whatever, I don't know, whatever computer-generated type of trading activity, that's what's going on. I think north of 75 or 80% of the volume on the New York Stock Exchange is exactly that. So, yeah, I mean, you can say that people are making decisions because they're obviously the ones sort of programming these things. But in this new brave world of AI and stuff, one has to wonder exactly what's going on. And I think, to your point, whatever got picked up by the algos is now sent effectively these buy programs in a meaningful way. And here we are at all-time highs in the S&P, probably approaching it in terms of the NASDAQ, although still a little bit off. And the volatility index, obviously, a lot tamer today than it was yesterday. But, it doesn't matter for the folks playing our home game who is buying or what is generating this stuff, because if you're long a stock and it's higher, the reasons why, although they should matter, don't really matter because you're still making money. But your point is well taken. I mean, this is given what we saw yesterday late, it's a bit of a conundrum as to why it sort of picked it up a day or so later.
Yeah, we haven't had a powerful move to the upside like this, 3% in the NDX and 2% or so in the S&P 500 in a very long time. I'll just say this, our friend Doug Cass over there at Seabreeze Partners in the streetpro.com, he sent us an email this morning. This is I think a number that you like to keep a close eye on. That would be the Buffett indicator. You take the market cap of U.S. equities, you divide it by GDP. You're getting to 200% right now. It's 2 standard deviation move from the trend. Pretty crazy stuff here. And again, we say this all the time, valuation, a very poor timing tool guy, but that has to kind of raise your eyebrows a little bit. But it's also like we're in a market where people don't give a crap about valuation anymore.
It's one of those things where, and this is not meant to be clever, but it doesn't matter until it does. And right now, that doesn't matter. And Doug would be the first person to say that metrics like that or valuations are a terrible timing tool, and he's right. And I think the market has come to understand that because, quite frankly, this market's been expensive for the majority of the move higher. But when you see something like this, 200%, again, you can read it for yourself, but a couple standard deviations away and some 63% or so higher than what is interpreted as fair value. And this is important as well, I think, before we get to Carter. I do believe there's a reason why Berkshire Hathaway, under the still leadership of Warren Buffett, has accumulated close to $280 billion or so of cash and cash equivalents. And people will say, the bull in the market will say, well, he's doing it because he wants to sort of have a clean slate for his successor. I don't think that's what it is at all. I think this is somebody that, regardless of his age or where he is in terms of his timeline for passing the torch, he's going to follow the rules that he has always followed. And he sees what we're seeing, and he's paring things down, waiting for the inevitability of that rainy day. Now, I will tell you, I'm shocked that it hasn't happened yet. We saw glimpses of it on August 5th, but these are one-day events, and the market is looking past everything we've talked about. And it's not just a Buffett indicator. There are other things as well. We had a great conversation with Mike Wilson last week about valuations and where this market is historically and where he thinks it should be trading. And there's, Case-Shiller indication. There's all different things that are flashing red that right now, with an S&P at, all-time highs, 57.20 up 100 handles today, doesn't seem to care about.
Yeah, I guess the only thing I'd say, and you mentioned this on Fast Money last night, Guy, the last time the Fed started cutting aggressively, in 2001 and then in 2007, essentially, the stock market lost 50% of its value over the next year and a half or so. And I think, there's nothing screaming, though, red flags. And the one thing I'll just say about Buffett with Apple is, like, he started buying this 10 years ago, and it became such a big part of this portfolio. And it just seemed like that seemed pretty obvious to me why you'd want to pare that back. But we'll hit some of those single names. Carter
and listen, that's fair. That's position management. And you're right about that. And that is not making a statement about the market as much as it is about the size of the position vis-a-vis the rest of the portfolio. I get it. But there are other things as well. But, that's not what we're here to sort of talk about right now.
Yeah, no doubt. Carter's got a hard out, guy. So we're going to
do it. Get him on.
Yeah, Carter Braxton Worth. Look at him. All knotted up, buddy.
I just got a lunch meeting coming up. All good. Right. How are you? Yeah, big day. But interestingly, sort of a lot of
moose boosh. This is a little, you know what I mean? A little starter here.
Yeah, exactly. It's a big day, and yet strangely, on a day like this, you get typically, talk about breadth internally, you'll get 470 stocks up in the S&P and 30 down, or you'll get 499. On the day, you have 133 S&P constituents down. So it's 371 thereabouts, 132. That's not typically, you had a big 3% kind of day. It's overwhelming. It's 5-1. It's so interesting that and of course what it is all those very stretched defensive names. That's the face of fear. So staples are down, the sector is down. Utilities, the sector is down. REITs, the sector is down. And then there are other areas that are not within the other stocks that are not within those areas of the market that are down as well. But it's important. Rotation the other way, right? Money has been crowding into safe haven names, yield names, and now it's finding beta, right? It's home builders are up a substantial amount, and semis and so forth. But we shall see. Interesting. And where it closes is everything, right?
The beta is interesting. And, you've been fading these crowded, the face of fear. You had a note out a couple of days ago. You've been fading those sorts of things. And I think you were trying to make the argument, it didn't have to be a beta chase for those things to come back in to some degree, but you're having that chase right now. There is some other interesting stuff though, like Cat guy is up like 5% today. You know what I mean? So I think this notion that you're going to have a reflation of activity, right? Like that would be the sort of thing that's kind of bullish for the economy. That's what I think that's what's kind of playing out here, but who knows? Carter, we spent some time talking about the underperformance of the NASDAQ relative to the S&P, the market cap. We've also spent some time talking about the equal weight S&P, how that made a new high, I want to say last week. But you're taking a look today at the NASDAQ versus the S&P 500. And we know that the NASDAQ has really lagged, right, since that August 5th sort of period or so. Walk us through what you're seeing, and maybe this can help us, Guy and me, and some of our viewers / listeners think about how to play these from here.
Yeah, so the point of this exercise for We're Charting subscribers yesterday was to make first the point that, if you were to just be walking on the street and say, people ask you, like when those, what are those videos that, it's not called TikTok or Twitter, whatever, someone just presents you with a microphone, who's the vice president of the United States, or who's the head of Germany? They give you some geographic question. What's the state next to Montana? If you said the QQQs, the S&P, which is the better performer in the past 3 years, most people would say, I mean, talk about not just random people on the street, but portfolio managers. Oh, it's got to be the Qs. Point of this exercise is the Qs and the S&P are dead even on a 3-year basis. And the reason one could say, well, isn't that arbitrary? That's when, if you did sort of AI searches on the term AI, that's when this first started. AI and semis and NVIDIA and Apple will do this, and Netflix and Google, whatever it might be. So the truth is, despite all of that, this aggregate of stocks, the S&P, the QQQ 100, with the top 10 are 50% weight. So you're talking about the top 10 names haven't done any better than the market. And you can say, okay, so what? But adjusted for risk, they're actually worse. So let's talk about that. If you're dead even, and yet at any two runners, they end up at the same spot, but if you had a peak to trough drawdown that was greater than the other, adjusted for risk, you're the worst performer. So let's look at that. Next chart. We know that the S&P on its low in the 2022 bear market, and you can see it there, clearly dropped 27%, and now it's rallied 64. Let's look at the QQQ. It dropped 37 and has rallied 98. So all things held equal, if we go back to that first chart, what we have is they're the same thing at the end of the day, but it's all about, and this happens when professional managers, what would have happened to me at any point, worst case along the way. That's what drawdown is all about. It's what determines Sharpe ratios and other things like that. And the green line is the underperformer. So going again, we see that there's the bear market drawdown. Next chart in the and this is okay. So this is another way to depict that. This is simply one thing divided by another. And so they've ended up at the same spot, but let's put the 150-day moving average on here. This has rolled. And I think that's the important takeaway that continues. One wants to still be underweight the Qs relative to SPY. So simple pair trade, it remains, right? SPY would be the long and Q would be the short.
All right, so let's play it out a little bit, because to say it is one thing, but then to see it visually is something entirely different. And again, this chart that we're looking at doesn't lie. And I look at that moving average, and I see something that for the first time in a while is starting to roll the other way. I mean, you saw what happened in March or so of 2023, how it started to turn up and then the significant move. Well, seemingly the same thing is happening now. So my question to you, I guess, is if we can sort of game it out, if the Qs were to underperform, I mean, does almost by definition the SPY get dragged down with it at a slower rate, or is this just, you think this is just going to be a Q thing on its own? Hard to answer, I know, but I'm just
there
curious.
is no answer to that, because what's kept them, we know where it's just the fixed amount of money, barring cash coming in off the sideline. But if the table is fixed, poker table, and the money is simply moving around between players, the money is moved out of certain players' hands, Amazon, Google, and so forth, and into Colgate and Procter and Walmart. And yet that is still some players winning and some players losing at the table. I don't know how that concludes itself for the S&P, other than to say that it's not the greatest structure for the S&P to have extended names that have downside risk, Walmart or Costco, while big super cap names have rolled. So we'll see. We are making a new high today, just ever so slightly, a new incremental high in the S&P, as all will know, just slightly above the July 16th high. How do we get follow through or not? It really is all about that, because there are a lot of false breakouts. There are a lot of bull traps where you draw money in and it craps out. We'll see.
So Carter, you've made your career in this business, looking at charts, charting them out, and helping a lot of folks, both institutional and retail, figuring out your craft. 27 years ago when I started in the business, I was at a hedge fund, and the guy that I worked for gave me one of those like big box compact computers I had to take home. I had to plug in AOL to get like the daily thing, and I had to look for different patterns in charts. And I didn't know anything. I took a New York Institute of Finance technical analysis class. He made me take that. And then he had 3 specific sort of things that he wanted: a breakout pattern after a long, consolidation, a breakdown, and then a V reversal. He liked those sorts of things. You the other day, and there's a little history there, but those are the patterns that I kind of know the best. But you've taught me a lot of things over the last 15 years since I've known you. You the other day put a note out to Worth Charting customers, and you were planning for a breakout in Meta. There it is, people. If you guys want that in your inbox, it's one of my first reads every morning. He does all of these videos explicitly there it is, look at that, for the subscribers there. You got to check it out, people. All right, let's talk about that Meta call, because it's a really interesting one. I know that you've been talking about this on a relative basis to the Mag 7. You've liked this thing. Talk to us why you like it and how you're playing it now. I know this is 2 days later and it's already broken out. Do you continue to play for the breakout?
Yeah, I mean, the breakout is underway. We're moving above all prior levels, so that you're into sort of free sailing, if you will. And once you're making an all-time high, just as a concept, remember, the only person that can be unhappy is someone who's short, right? By definition, there's no one who doesn't have a profit. Some people have huge profits. Some people have only minor profits from days prior. But the only person who has an unhappy experience is the short. And at some point, the higher it goes, that squeeze becomes uncomfortable, and they cover. So represents prospective yet further buying. But either way, we're broken out. Let's draw the lines. It's all very straightforward. We can flash them, like the vacancy sign or no vacancy sign on the motel there. I mean, it is what it is, right? And so how much higher? Hard to know. But here's the all data chart. Since Meta's IPO, that's a channel that kind of projects to as high as 680. We shall see, but I think it's important to be long this stock, and that was the point of that note in anticipation of this breakout a couple of days ago.
And that was correct. I mean, you go back to, and one of the things actually we have been positive on has been Facebook for a while. And if you look at their last quarter, and Dan can speak to this, but them and Walmart are seemingly the 2 companies that have been able to monetize and get a return on their investment in terms of the AI spend. And you saw it in spades in the Facebook quarter. So good for them. And despite this move, valuation wise, it's still something actually you can wrap your arms around and get your head around as well, Dan. So great call by Carter, typically. And, if you look at this chart, this channel that we're in, and we've been on the upper band for quite some time, with time decay, I mean, this thing can continue to do the grind, and get north of potentially 600 pretty easily, Dan.
Yeah, listen, I think from a purely technical standpoint, you can see where it's going to go, and then it's going to be like, it's going to be a battle there. And I just think as we get to the end of Q3 and we start thinking about what, guidance is going to be like for Q4, and then when you incorporate his call on the underperformance of the QQQ, I'm kind of less inclined to play these things for a runaway. Maybe you get to that extended level, but again, that's a combination of technicals and fundamentals. All right, Carter Braxton Worth, we know you got to get out of here. We really appreciate you being with us here, and we'll see you next week. Guy, I want to hit you on it's similar to that Meta setup. We've been talking a lot about software versus semis over the last few months. We know what's been driving the semis. If you think about NVIDIA, which is up, 150 some percent or 141% or something like that on the year. Taiwan semi is up like 75% of the year. Those 2 stocks make up, 40%, I think, of the SMH, the ETF that tracks semiconductors. just broke out a little bit. You see the underperformance. We know what's going on there, but I don't really want to focus on the SMA trade here. And maybe you'll give us your take in a second. That looks maybe like the formation of a Head and Shoulders. Who knows? Let's talk about IGV. All right. This is the software ETF.
Software.
And yeah. And two of the largest components have been big laggards. This is the number 2 and 3 components, Salesforce and Adobe. Adobe hasn't seen basically an uptick in a week. It is today. It reported last week, big gap lower, kept on going. Salesforce is having a day, guy. This is one that's up 5.5% or so, which puts it up on the year for the first time in a while. When you see that chart, when you see the potential for investors chasing laggards, which Adobe and Salesforce could fall into, do you think we're going to get the sort of breakout that Carter just talked about with the Meta?
Well, this is it better do it soon, because here we are, right? We're at this prior level that we saw back in February. And if this is a static chart, but if Jacob or Amanda or Timmy can put up a longer term chart, you sort of get a context of what's going on here. And everybody loved software for the longest time. And then I think as AI came into the fold, things flatlined in a pretty meaningful way, because the investment dollars were going to AI and they were probably coming out of software. So that's the rub there. But here we are at these prior levels. And I think it's really important. You see that moving average is flattening out. That's 150-day. In order for that to sort of change trajectory higher, we obviously need to break through. Now, you mentioned Adobe. Let's put up an Adobe chart real quick, because we mentioned this on the OK Computer podcast, which I don't know if it's dropped yet, but it's something you should check out. But if you look at an Adobe chart in real time, go over the last couple of years, you'll see that recently, and we need a little, yeah, that's probably good. You see where we traded down to. So this recent low, I'm sorry, Dan, we traded down to basically the levels that we saw back in August. I'm looking at the wrong chart. Can you do shorter? I'm sorry, Jacob, the shorter term. My bad. But my point is, there you go. So we traded down to that August 5th low. You can see it right there. And we are seemingly bouncing. We're right at the 150-day moving average. Now, there's a chance that, we sort of stall here and fill that little bit of a gap we have to the downside. But, I think this is one that you could probably play from the long side, which almost by definition means I think the IGV is probably going to break out through those. It's a long-winded way of saying I think the IGV is about to break out to the upside.
Yeah, and just go back to that 5-year for a second. So yeah, I like what you said, Guy. It better do it now. This is in the IGV. Let's pull up the 5-year that we have made. Because, big technical resistance. And at the end of the day, listen, technicals are just one component of it, right? And so if we were to have a reversal in the market, or the QQQ continues to underperform the S&P, as Carter just detailed, you have a situation where maybe these aren't the places to be, but you'd rather buy a constructive chart where people are chasing beta, where maybe there's the fundamental story that's about to change or inflect a little bit. So for whatever that's worth, that makes some sense. Let's go back to the semis, though, Guy, for a sec. Thoughts here, because, again, we just said we know what's driving it. AMD joined the party a little bit today. There's some names that are big laggards in this. Qualcomm, AMD's up today, but it's been a big lagger. Micron is not trading particularly well. Let's go to the 1-year really quickly on the SMH2. You see that it's picking up its head above that downtrend. Let's go back to the 5. The 5-year, just, we know what's going on there. So thoughts here.
There's going to be a school of thought that lower rates is going to be supportive of semiconductor stocks in terms of valuation, in terms of a number of different things, the ability to investment dollars and access to credit I get it. And that's obviously the bull thesis, but part of it is contingent on rates going lower. And I'm not convinced that's what you're going to see. I get what the Fed did yesterday, but if you look at the way the TLT traded yesterday and what's happening with rates now, there's actually a scenario where 10-year yields and beyond could actually start going higher. So I think for today, or at least, I think it's somewhat misguided, the optimism around semiconductors. And I will tell you, if you look at NVIDIA specifically, today notwithstanding, since June 20th, it hasn't traded particularly well. Now, it's had a great bounce off that August 5th low. I'll be the first to say that. But again, if you look at it, S&P 500 making all-time highs today, NVIDIA made its all-time high, approximately 2 months or so ago. So it's just bears watching, because with each passing day, the ranges are seemingly getting more and more narrow. And I think the market's going to come to the realization that, hey, wait a second, maybe some of the metrics around this stock specifically are not as, I don't know, are not as appealing as one thinks. And I'll say this as well before you go back to you. All the adjacent names seemingly in the space have not traded particularly well now for quite some time.
Yeah, no doubt. Let's talk a little bit about what the banks are doing after this Fed cut here, how they're thinking about the S&P 500, some of the targets here. Amanda put together a nice little slide here. Listen, it's not surprising. Most are pretty bullish, on this rate cutting cycle. We've spent a lot of time talking about a bull steepening in the 210 spread and what that means. Liz Young had some really good data yesterday. And we can maybe put that in the show notes about what happens in rate cutting cycles and recessions and the like here. Again, you can see what's going on here. I think most folks, some were surprised by the 50. I don't think anyone, though, Guy, the stuff that I read here today, this morning, was like, oh, they did it because things are falling apart. I mean, like, that wasn't part of the narrative. And I know that leading up to the cut, there were some folks who were saying that could be the case if they go 50. But when I listened to Fed Chair Powell yesterday, and let's assume we can take him at face value, right? Let's assume that it wasn't a political cut, that sort of thing. You got to ask that question in the presser. He made the point that their dual mandate, stable prices and full unemployment, that there were basically, they came in line here a little bit, which gave them the opportunity to do that 50 basis point. So again, the stock market is not the economy, but the stock market, at least those who are making decisions to press the buttons to buy, think that we are firmly in a soft landing right now.
100%. And they'll say, the optimists in the market today is saying they cut rates 50 basis points because they could, not because they had to. And I think it's somewhat nuanced, but I think it's important distinction. The had to camp is things are breaking down in a meaningful way and they better get ahead of it. The they can camp is they have inflation under control. The unemployment rate is still, it's moved higher, but it's still historically pretty low. And now they can start to try to massage that vis-a-vis interest rates. We'll see. I mean, and again, the optimist is going to point to the 1995 analog and say, this is what we're looking at. The pessimist will point to the early 70s and say, wait a second, this is probably more like it. It turns out, there's always some new wrinkle that's involved. But I'm one of these people that do think the unemployment rate is going to continue to sort of stair step higher. The debt problem we have is not going away anytime soon. Consumer debt continues to pile up. The consumer might look great through the lens of retail sales, but then when you look at it through the lens of delinquencies and those types of things, not so much. And there it is. There's the rub. So we're going to see if we get the 14% earnings growth that the market is anticipating. I'm not so sure we're going to get that. But right now, the market is full speed ahead.
Yeah, about a month from now, we're going to start getting Q3 earnings, Q4 guidance. A lot of folks are going to be focused on really how 2024 ends up. We know that, consensus is up for 10, 11% earnings growth, and that might help be a little bit instructive, but 14% expectations for next year, but it's going to be way too early to see that. Really quickly, Guy, BMO, they raised their price target in the S&P 500 to 6,100 by year.
They're probably high in the street now, I think.
Yeah.
Yeah.
So let me ask you this. Okay. Let's take all biases out and everything like that. Let's say we get to a month from now. Let's say the S&P is here or a little higher or here and a little lower. Let's say plus or minus a few percent. And let's just say Q4 guidance does not lead strategists to kind of ratchet their numbers down for Q4 and maybe gives them more confidence about the first half of next year. I could see things. I mean, listen, there's plenty of geopolitical, there's plenty of election risk here and this and that, whatever. Like, could 6,100 be in the cards from 5,700? Sure. You know what I mean? But it really pulls forward a lot of potential performance for next year.
The way the markets trade, the sell-offs have become, August 5th notwithstanding, but in terms of duration, I mean, they don't last long at all. The snapbacks are violent. The VIX, I still think is going to be a story, but clearly not today. So, yeah, when you only have when these sell-offs are only 1 or 2 day events, and everybody from the hilltops is screaming buying opportunity, buying opportunity. Yeah, can 6,100 play out? I guess. I mean, I'm not, as I've said a number of times. I mean, the market can stay sort of a little zanier longer than you can stay solvent, and I think that's what we're in the midst of now. But when valuations start to matter, which eventually they will, I think people are going to wake up and say, wait a second, this is a pretty expensive market in this environment. And I would still pay a very close eye to the re-steepening of the yield curve and historically what that has meant, and whether or not 10-year yields start to move up in a meaningful way. We had a great conversation yesterday with Luke Groman. It's going to drop, I believe, tomorrow. And we talked about the $15.5 trillion of treasuries that need to be refinanced over the next few years, which, at some point the bond market's going to wake up to. So look, a lot of things to be extraordinarily excited about today, but the things that I've been concerned about have not gone away.
Yeah, just really quickly, also taking away from the Fed chair's comments yesterday and then the presser and some of the answers that he gave. I mean, they expect unemployment to be 4.4% at the end of the year. They expect, really 2.2% GDP growth, which basically is what the average was over the 10 years prior to the pandemic. So they're basically saying soft landing, right? Because here we are, 4.2%? Is that what we are in the
last reading was 4.2? Yeah.
Yeah. So like notching a little. So how might investors be more focused on valuation? It would be greater than expected unemployment, right? And then weaker than expected growth. And then you'd have a bit of a sell-off because it give you less confidence in next year's earnings number. So that makes some sense. Guy, before we get out of here, we got to look at the banks because we've talked a lot about financials and what rates meant on the way up and what they could mean on the way down. Here's the BKX. You see that we were in a nice little uptrend here. You see that resistance level. We're up against it again. I just want to go out to a 5-year chart really quickly, and it shows you that resistance is right at the point where the stuff. So thoughts here on banks, because I'm looking at the money centers today. Most of them are trading pretty well, up between 3%. Citi's up 4.25%. Wells is up 3%. Bank of America is up nearly 3%. JP Morgan's only up 1.25% or so, which makes sense. It's been a bit of an outlier for most of the year. Thoughts here on banks?
This is the market saying, we have a normalization of the yield curve. This works to the bank's favor. And that part is probably true. But the flip side of that equation is, that's going to be more than offset by, I think, a slowing economy. So if you have one thing working for you, but something else working against you, maybe 30% more than it works for you. I mean, theoretically, all these things are doing is getting themselves more expensive. Now, again, I understand the optimism. I understand all the reasons why people want to be constructive of the banks. But if you really look and see what's going on, I mean, we're entering late cycle stuff, which theoretically shouldn't be particularly bullish for banks, in my opinion.
Yeah, I don't disagree with that. And the last thing I'll just say about that NASDAQ underperformance, how we started the show with Carter, look today. I mean, Apple's obviously blowing out 4%. I don't know what the hell's going on there, but Microsoft's up 1.7%. Google's up a little less than 2%. Amazon's up 1.6%. So some of the names that have done a lot of the heavy lifting in and around the Gen AI trade, not the semis, okay, but these kind of hyperscalers, if you want to call them that, underperforming, which just speaks to a broadening out, which we've know has been going on. But if the market can't get going or those names can't get going, I'm hard pressed to think that there's that much upside in the NASDAQ relative to the S&P 500. But I'll just leave it at that. Guy, I know you got to get out of here, buddy.
It's all good. I've enjoyed this. We will be back tomorrow. Now, tomorrow's Friday. We typically don't do market call on Friday, but we took Tuesday off because we were traveling. So we'll be here tomorrow. Tomorrow we'll do a lot of Q&A because I get the feeling tomorrow's going to be another market day. So tune in for that for sure. Market Matrix, obviously, check that out. YouTube channel, Risk Reversal. You should absolutely subscribe, smash the shit out of the like button. And of course, Market Matrix is something you should be taking a look at as well.
Matter of fact. All right, Guy Adami, Dan Nathan here. Thanks everyone for being here. Thanks our team. They just kind of kill it for us. We just show up. You're the pretty face, and I'm just kind of grinding it out a little bit. So we appreciate everybody. Thanks. We'll see you tomorrow, 1:00.